What's going on, everybody? It's Spencer Gray from Gray Capital. I appreciate you watching this video. We're usually talking about multifamily investing, real estate investing. So if you are a multifamily investor, want to learn more, make sure you subscribe to the Gray Capital YouTube channel. You get all the Gray Report videos so you can stay up to date on what's going on in the multifamily industry. Well, today we're talking about private equity structures in a structure that's a little bit different than maybe your kind of typical structure that you see in a lot of real estate syndications. You know, in these real estate syndications, they're essentially just private equity deals with private equity structures with a group of passive investors, and then a group or the LPs, and then a group or individuals, that is the general partner, that are the active investors that are going to actually run the deal and execute the business plan. But how do you kind of chop up, who gets paid when, at what rate? There's some kind of standard ways to do it, but what are some of those unique ways? Let's get into that today. So one new private equity structure that you may have seen if you are an investor or a sponsor of multifamily syndications and any kind of real estate syndication is a dual class structure. You may have also seen this referred to as just being simply A shares and B shares, or A units and B units, kind of with different return profiles. But how is that different from what we would call more of your traditional and standard private equity structure? And what's the point of these A units, A shares, or B units and B shares? So Gray Capital historically, and Gray Capital is the multifamily investment firm that I run, targeting multifamily properties, usually 100 units or more, mostly in the Midwest. The way we've structured our past projects have been one of the more simple and standard ways to structure a real estate investment or a private equity investment. And that involves having a single preferred return, really only one class of units or shares. Usually these are partnerships, LLCs, so we're talking about membership units, not shares in a corporation, but they can be used interchangeably. Typically one class of units that have a preferred return followed by a simple split of proceeds in excess of that preferred return, split up between the limited partner and the general partner. That structure you would see typically call it an 8% preferred return, although it can range anywhere between 6 and 9%, followed by a split, most commonly we'll see in real estate, of 70-30. So after the preferred return has been paid, there's a split of any excess cash flow. 70% goes to the limited partner passive investors, and 30% flows to the general partner group or the active investors. That is the typical structure of operating cash flow. Now, if a capital event occurred, such as a refinance or a sale, what would then happen is the preferred return of members would be made current, so they'd get paid the preferred return. Then 100% of their capital would be returned to the LPs. Then the 70-30 split would come into play. And keep in mind, for these preferred returns, it's not a guaranteed return, but it is something that if you do not receive, it accrues, and you will receive it eventually, assuming that the project at some point in time has the actual cash to pay that. So if you have an 8% preferred return, you only get paid 4% for that year. That remaining 4% will accrue to following years. And before any other cash can be paid out, that accrued preferred return has to be made current. Or at least that's how a lot of multifamily and private equity deals are structured. So this single class structure is how Gray Capital has structured almost all of our deals in the past. But when we have conversations, or I've had thousands of conversations with investors, and one of the questions that I always ask is, where do they fall in their preference, and really how do they weight their preference between upside and just value appreciation, or think of it as growth, versus cash flow, yield, and income? What I found out and discovered is that almost 80%, the vast majority of investors or potential investors, are all looking for a balanced return profile. They want cash flow and income. They also want upside. But then there's this group of investors, makes up about 20% of them, that are either all upside. They could care less about cash flow. Maybe they've got a high paying job. They're already invested in a lot of cash flow in real estate. They don't need the income right now, but they would like to multiply their capital and get the highest overall total return, IRR, or equity multiple. On the complete opposite side, there are some investors, these typically may be older investors or folks that have like a high net worth, but they're looking to generate income and yield. Maybe they have a large bond portfolio that's only throwing off 2, 3, 4%, and they're looking for a higher yield on their capital, on their money, but they're looking for a place where they can get more than 4%, which at 4% at least in 2021 and early in 2022, it's actually a negative real yield if you factor in inflation. So after having all these conversations, understanding that each investor has a slightly different preference and weight on how much they value income, how much they value upside. And so we asked ourselves, is there a way that we could structure these projects where we could tailor our return profile and risk profile, because the two are obviously directly correlated, to match the needs of individual investors while we're all pursuing one singular asset or one singular objective in the case of a fund of assets. So as you may have heard, Gray Capital, we have launched the Gray Fund. We're going to be acquiring about 10 multifamily properties, about $300 million worth of assets over the next few years. And so we were looking at what is the best structure. Let's just not keep doing the same thing we've done in the past over and over again, even though it's worked well. Is there a better way to do it? And we noticed some other syndicators and some other operators had started experimenting with this dual class structure where there is a certain amount of units available, call them the A units, that have a higher preferred return, typically 10% preferred return, but with no upside. And then there are B class units that typically have a lower preferred return, call it in the 6 to 7% range, but they receive the lion's share of the upside because the A units themselves don't receive that upside. But also when we look at the risk, you're front loading the A units as they're in a priority position compared to the B. They're getting paid first, a higher preferred return, but they're not getting that upside. The B units, they're in a secondary position, so theoretically slightly higher risk, but they're getting the advantage of still a moderate preferred return that accrues even if it can't distribute, but then they're getting a much larger chunk of that upside. So the true primary advantage of this dual class structure, because I know it can get complicated pretty quick, but it doesn't have to be, it's a lower cost of capital. And this is advantageous to the sponsor or GP of a multifamily project, as well as the limited partner, because it allows for a lot more flexibility in, again, tailoring that risk and return profile. So getting an overall lower cost of capital, you could think about it as getting more leverage without taking on any more debt, or paying a lower interest rate on your mortgage itself. Because again, if a percentage of these A-class units have their upside capped, you're only paying the A units that 10%, whereas if it was in the traditional private equity structure, their rate of payment would be essentially whatever their IRR would be. So you may end up paying those investors a 15 to 20% IRR versus 10%. Now again, the advantage then, depending on your preference, goes to the B units if that preference is upside, because they were able to harness all of that upside that no longer flows to the A units. So A and B units, so on the surface, it seems like it solves for folks that are just interested in income or they're just interested in growth. But again, that's only, like I said, 20% of the investors out there. Almost everyone is seeking some kind of balance. Again, it's an anomaly if someone's only on one side of the coin or the other, but there's different weightings. Someone may say, I am really looking to generate mostly cash flow, but I do want a chance for upside. I do want to get a decent multiple on my capital. That's where we really came up with the concept of, well, what if instead of seeing it as a binary choice of A units and B units, what if we use a combination or a blend? Using these two blocks, these two units, A units and B units, by investing or purchasing a combination of these units, you can create a tailored risk and return profile based on your exact needs, goals, and preferences. So let's look at a couple of examples, and this is taken from projections for the Gray Fund of kind of different breakdowns and ratios between A and B class units. So let's assume a $100,000 investment, which is the minimum of the Gray Fund. And then let's also assume that each unit itself is $25,000. Therefore, over $100,000 investment, you have 4 units to choose from between A and B. Now again, if you were only focused on income, you could go with 4 A units, 25 apiece for the $100,000, and that would produce $10,000 per year in preferred return, or 10% pref. Now over a 5-year period, your eventual equity multiple is going to be a 1.5, 5 times that 10% for that amount of years. But you're limited. The upside is only that 10%, but you will receive monthly that 10% annualized preferred return. So let's say your priority is income, but you do want just a little bit of upside. So let's say you go with 3 A units and then 1 unit of B. That blended preferred return, although they're in different positions in the capital stack, is going to be 9.25%. That's a high preferred return. You're not going to see that in very many real estate projects, especially if you're getting some upside. Now, a projected IRR for that ratio of 3B to 1A is a little over 12% IRR. Now, that's blowing the historic return of the S&P 500 out of the water over a multi-decade period. Maybe not the last couple of years, but you're still getting an overall pretty decent overall total return in IRR, but that may not be sufficient for folks who are looking for more growth. Let's say you're looking for an even more balanced approach, so 2 units of A, 2 units of B. That's going to leave you with a blended preferred return of 8.5%, which is a solid preferred return, and an IRR that's projected to be a little bit over 14, call it 14.25, and a pretty nice equity multiple of 1.86 over a 5-year period. Now, that may be not enough growth, may not be enough income, but if you look at other offerings, you look at what else is on the market, it's hard to find a preferred return over 8%, and then still getting, a 14 plus IRR is a relatively moderate overall internal rate of return and total return. But it all comes down to your preference between income and growth. Okay, getting to more of the growth-oriented side, let's say if we go with 1 unit of A, but 3 of B. So your blended preferred return is going to be 7.75, pretty solid. The internal rate of return over a 5-year period is just under 17%, and you're just barely under a 2x equity multiple over a 5-year period. And this is going to be a return profile that most closely resembles and mimics our traditional and older private equity structure, or private equity structures you may see in other syndications with an 8% preferred return in a 70-30 split. If that return profile is what you're used to, it's what you prefer, then that may be the right balance for you. Again, that's 1 unit of A and 3 units of B. All right, now if you are only interested in growth, not really focused on income, hey, maybe if there's a little cash flow, it's all right, but I'm looking at the overall equity multiple and IRR, then you may just go with 4 units of B. Again, those 4 units of B, they're gonna have a 7% preferred return, an 80-20 split. Instead of a 70-30, it's actually an 80-20 LP-GP split. And then there's a further down the line waterfall hurdle over an 18% IRR. The split actually switches to a 60-40. So if you go with all B units, you're going to get that 7% pref, but where the real advantage is compared to closer to a 15% on the more traditional private equity structure, you're actually looking much closer to just under a 19% IRR and basically a 2.2x equity multiple over 5 years. And again, that'd be comparing closer to a 15 IRR under traditional private equity structure and really just a 2x or sub 2x over a 5-year period under a similar or older private equity structure. So who is this really benefiting? So is it benefiting the GP and Gray Capital, whoever the syndicator is, or is it benefiting the investor? Who's really getting the advantage here? And the honest answer is that it's both. The GP has an advantage because there is an overall lower cost of capital, but that advantage also flows to the B units because that overall lower cost of capital is advantageous to produce more upside. You may be asking, okay, well, what's the point of investing in A units? I don't get any upside. I don't see the point. Well, there's really 2 ways to look at it. One, if you are currently invested in bonds that are yielding, again, negative real yields, getting 10%, which again exceeds the long-term average of the S&P 500 over, I think, a 5-decade period, to be in first position you have significantly lower risk, so a lower risk profile than you would be able to achieve, again, on a traditional real estate syndication with one class of equity. Because in that one class of equity, everyone needs to be paid back at the same time, but with the A units representing a smaller percentage of the overall equity, you will be paid first. And so if there's, in a worst case scenario, if the deal goes bad and there's only a little bit of cash left over, but not enough cash to pay everyone back, all of the investors to return their capital, the A units will be paid first prior to the B units. So there's really a lowering of risk, which again directly correlates to a lower return. But really, again, the use of the A units is to be used as a tool to really engineer and tailor your own risk and return profile, adding flexibility, functionality, and taking away just a kind of one size fits all when we know that so many individuals and entities have their own unique return and risk profiles that they're looking to achieve. And this is one method that we can help them do that. I know that was a lot. It's simpler than it seems on the surface, and the advantages I think outweigh any complexity. When we first started modeling this structured grey capital, it was a no-brainer that this was the direction that we wanted to go. If you're interested in learning more about multifamily investing, the multifamily market, make sure you're subscribed to the Grey Capital YouTube channel. You're signed up for the Grey Report newsletter over at greycapitalllc.com. And if this whole idea of investing in multifamily real estate with an experienced sponsor that has over $500 million of assets under management, we've invested over time in 10,000 units, sold a lot of those, bought more, get in touch with us at Grey Capital. Like I said, the Grey Fund has just been launched. We're going to be purchasing $300 million worth of multifamily assets, all cash flowing, primarily in the Midwest, A and B class assets, kind of 1980s and newer. If you'd like to be kind of a part of the team that's going after all these great opportunities, reach out to us on greycapitalllc.com. You can join the investment club, schedule a meeting with one of our investment associates, and we'll get the ball rolling. Looking forward to having that conversation. But if you just want to keep learning more, that's great too. Appreciate the like, subscription, and again, leave a comment below and we'll respond right away. All right, thanks, have a great one.